What's up, guys? Last week was pretty tumultuous, and here we are on another Sunday before another week is about to begin, and I've got a feeling that next week is going to be even crazier. So let's get at this. Now, last week, if you recall, I opened a position before the week began of about $80,000 on a single position on UVXY, which is a long volatility levered ETF. And I bought that because I thought there would be an increase in volatility in the coming week. And well, let's see what happened. It has increased to about 84,000, so about a $5,000 unrealized gain. Unrealized meaning I didn't sell this. I still own this, right? And I haven't touched the position. And there's a reason behind that, because I do think next week is going to be even more volatile. Now, let's start with things that I got wrong last week, because nobody can tell the future. And people, there's a lot of people who talk about what's going to happen in the markets, and they always talk about what they got right and never come clean about what they got wrong. And I just don't like that, because you're not telling the truth and you're not being honest about the journey that you're taking. And I've got my own cash in this, right? I'm putting my money where my mouth is. So I want to tell you, when I do get things wrong, what I got wrong. And the first thing I did get wrong was about the yen carry trade. Now, what happened was there was an election, and an improbable thing happened where the wrong prime minister basically won, right? And this guy, like I said in the earlier video, was a hawk. And so the yen, after hours, this happened after markets closed the last Friday, shot up like crazy, because he's going to raise interest rates, right? And likewise, the Japanese equities futures, because this happened after the market closed last Friday, fell 5%. I mean, this is a huge drop, because Ishiba got elected, which was unexpected. So I thought, new prime minister, he's a hawk, yen goes up, Japanese equities tank. Over the weekend, we might have another carry trade implosion. Carry trade implosion happens when the yen goes up. And so that's why I bought the positions back then. But what happened, actually, was he made a U-turn, right? Come Monday, the guy steps into office and he's like, oh yeah, we're not gonna increase rates. The Japanese economy is not ready for that. And so that kind of just made a complete U-turn and killed the yen carry trade, at least for now, right? And so when you look into what happened, he basically called a snap election, right? And this is why I think everything made a U-turn. And he's actually a really smart guy. He called a snap election because he wanted to take the momentum, basically, that he has on this win that nobody really expected, to clear out the rest of the government, right? And by calling the snap election at the end of the month, so soon after getting elected, he has a shot at actually clearing out the rest of the government parties in Japan. And so, yeah, if he's going to call a snap election, he can't have the economy like completely unravel right this second, right? He's got to keep things going until the snap election occurs. And then after that, he can reveal his true cards. So for now, at least until the end of the month, I think Japan's going to be in a very good state, kind of like the US economy with the upcoming elections. You don't want to like mess things up. And Japan is in a similar situation, at least until the end of the month, where until the snap election happens and he gets to clear out the government, he's not going to really raffle the waters, because he wants to win the snap election. So I got that wrong. Now let's look at what happened throughout the course of last week. On Monday, we basically had this dip because Powell came out and said, hey, we may not raise interest rates as 50 basis points going forward every day, so the market kind of tanked. But then by the end of the day, we had this huge reversal from here. I mean, this is a huge amount, right? Right here from bottom to top, because basically it was end of month and there was a lot of big funds that it was only not just the end of month, it was also the end of quarter. And so a lot of big funds needed to close their books and open new positions, and they do what they like to call painting the tape, which is to make things look rosy so that they can, close a quarter on a good note to their clients, say everything's great. And so boom, we had this, which I kind of expected. And There was a comment earlier in one of the comments in my last video about how I trade and whether or not I have stop losses or not. I don't have stop losses, and it's particularly because of this reason. Stop losses is when you say, oh, programmatically, if a price hits a certain level, just sell, right, and cut your losses without any human intervention. And I don't do that because guess who sees everybody's stop losses? The market makers, and also the big boys. And so they can see all these individual little guys with their stop losses. And sometimes they do what is called a stop loss run, which they just go pick it up, take everybody out, and go back up. And this is an example of how you have a stop loss run, which is exactly why I don't use them, right? I basically use my experience and psychology and discipline to understand what to do or what not to do. Then after that, we had this big drop, and what precipitated this was the whole Iran-Israel conflict, which I did get right in the sense that I said this was going to escalate, and it might escalate in the following week, and it did. And so we had this huge drop, and ever since then, we've just been trading like crazy, up and down moves because of basically news tidbit driven moves, like, oh my God, they're going to go, oh no, they're not going to fire. It was basically this. And so this is like no man's land, right? And so that's why I just left my position where it was, because this is good for volatility, right? Nobody knows what the heck's going on until basically the end of day Friday, where guess what? We had a crazy good jobs report, right? Unemployment ticked down by 4.1, but the jobs was like over 200,000, jobs, which is way above even the most optimistic estimation, right? This was like a 4 sigma beat on the market expectation. So super, super, super good job news, of course, right? It's the last one before the elections. So of course they're going to give the impression that the economy is doing super well, so the incumbent can get reelected. Come on, right? Like, I don't need to go further into this, but look, it's expected. If you think that they're not doing this and that there's no political motivation behind some of these numbers, yeah. So anyway, it skyrocketed, and then it kind of like, went down again. This is why you don't also do a program in Excel because they do the same thing that they did on the way down and up. They'll do the same thing up and down, and guess what? It went back up again at the end of the day. Now I was faced with a challenge here. Should I just cut my just take the win, right? I have $5,000 basically, which is, for 1 week's worth of one trade, which took literally a minute to buy, so for 1 minute's worth of work, should I take the 5,000? That's not bad, right? To make in a week. I decided not to, and we'll talk into why I kept the position over the weekend going into next week. If we zoom out a little bit, before we zoom out, let's take a look at one of the things that did happen. So, this goes into one of the reasons why I kept it. This is, okay, I don't want to get too technical, but basically this is dealer gamma, and it has to do with options trading. But basically what this is telling you, right, is that the market's free to run. So until this happened, what was going on is it's like a sink, right? Like the simplest way I can explain, it's like a sink, water going down a sink. Sometimes the sink gets a little more cloggy, so the water doesn't run down as fast. That's basically what this is representing with the stock market pricing, right? Basically, until the end of the month and last quarter, there was a lot of activity on buying and selling, like these big funds with huge positions had that would like clog the movement and slow things down so that it couldn't really go up or really go down quickly up the ladder or down the ladder, because there was these huge funds with protecting basically a certain price range until the end of the month and, more importantly, end of the quarter. So it was kind of stuck in this range, right? You really wouldn't be able to make much unless something crazy would push the clog in the drain down, like, sticking your finger in and pushing it down or doing one of this. It's kind of clogged, right? But what happened is it's cleared now. It's cleared, right? The clog has been cleared. And so what that means is the door is now all open for a very fast move. It could be up or down, but basically the drain is cleared and there's room for big, big moves. And so this is part of the reason why I left it in, because if there is a big, let's say, move to the downside and increased volatility, it will be major. And I'm talking about something, we haven't seen in the past couple of weeks, something worth, in my opinion, keeping my position in. Zooming out, we'll see, here's the monthly. So this is a monthly chart. I mean, sorry, this is a monthly chart over many years. Each one of this is 1 year, right? This is a year, this is a year. So you got to keep in mind, this is a long-term chart. But, again, what we're seeing here is this is starting to curl. Now, if you saw my last episode, I told you that this line is my an algorithm I created myself based on a bunch of things. Go check out my earlier video to understand what it is. But basically, last time it wasn't curling, but now it's starting to show. Now, the month of October is not yet over. That came out funny. Over yet. But what you're saying is that even though it hasn't ended, we're beginning to see it curl, right? So a bunch of things going here. We've got a diverging long-term, right, decreasing RSI, negative divergence. As this is going down, lower highs, we're making higher highs. And this is a multi-year divergence, right? So this is a huge time frame for a divergence to happen. That's one thing, and we're right at the peak here, right? So chances are we're not going to cut through this. Chances are we're going to respect this descending line here. The other one is, of course, my algorithm that I said is starting to curl, and also the MACD over here is starting to. I mean, how much more room does it have to go up here? We're at the 100% of the last time, so likely we're gonna not overshoot here and start curling along with my proprietary indicator, and that here would also be a negative divergence, as this has been going up, and this is essentially likely going to remain in a horizontal state. And October is a month of volatility seasonally, and so if something were to happen, it would be now until basically the end of October. The things that I did get right, aside from the Iran-Israel potential explosion, was what was going on with China. And so China, like I said last episode, unleashed basically all kinds of fiscal monetary policy to prop up the market, and that resulted in an explosion in its. I mean, this is a literal explosion in its stock market, right? Like crazy. Like we haven't seen this since 2008 in China. And China, remember, in 2008 kind of saved, right? If you recall, the global economy after the 07-08 financial crisis. Like they were the ones who pulled us out. Go study your history if you don't know what I'm talking about. And ever since then, this has been the biggest one. So this is like crazy. And one thing to keep in mind, though, is that if we zoom out, that's it, right? So we've seen this before, and it's never really worked, right? We're still stuck in this range here, and we've had crazy moves up. And so what they've done doesn't guarantee that this is going to really work. In other words, they're probably going to have to go full bore out, which means they got to do QE, or quantitative easing. And I think that's coming. So I think China is actually going to do quantitative easing. I don't think they have an option. And that means everything is going to go up in price. All the commodities already have gone up. They're going to go up even higher. Gold is going to continue to go up higher if China does QE. And to some degree, I also think the digital gold, or Bitcoin, probably will as well, because you can't escape the flush of liquidity being pumped into the market by the second largest economy in the entire world. It's coming. So moving along here, the other thing that I'm looking at that I saw, I probably want to keep my, position, is what we saw with the dollar, right? So with that crazy jobs employment report, what happened was the dollar just spiking up. This is like the reverse of what happened with the yen spiking up, right? I mean, in terms of yen versus dollar, like the yen spiking up, well, the dollar spiked up like crazy, right? Crazy. And this was at the beginning of the trading session, and it just stayed there. So it wasn't unlike the yen, which was after I was trading. This was during the trading session, it stayed there. And it was driven by the crazy jobs report, meaning, look, the economy's, so we've got, according to the data, right? Again, this data that I don't know if you want to believe, but according to this data, the job market is on fire. The GDP is increasing at a good rate. Housing prices at all-time highs. Stock market at all-time highs. Why would the Fed do a jumbo rate cut all of a sudden? What is going on, right? A jumbo rate cut's like, yo, man, bad things are happening. We need to save the world, the economy. We're going to do a 50-point basis, 50 BPS cut. Doesn't add up, right? Just use your common sense, right? Forget about all all the complicated rabbit holes. Just boil it down to that, and you'll see something obviously is not adding up, right? And a fifth grader, that's what I love about children, is they don't get lost in all this academic and all this mishmash. They'll just keep it to the simple, commonsensical thing. A fifth grader will be like, yo, man, doesn't make sense. What's going on here? I tell you, something is going on, and we'll find out soon. Moving along here, we'll see that in the longer time frame, what is going on with the dollar is we look like we may have put in a double bottom here, right? And this is a 1 year chart. So if that is true, we may look like we are going into a higher dollar environment for the next year or so. And that's not good, right? The dollar, a strong dollar, and the stock market is inversely correlated. It's not a perfect, like the coefficient of correlation is not like super high like it is, let's say, with interest rates is to NASDAQ, for example, or small caps, but it's there. And this is another factor of why I think, hey, look, if this continues to go up, we're going to have more volatility and downside to the equities. Now, this chart is the other part where I'm like, yo, man, basically non-dealers. So this is people like me, right? The dumb money, right? The individual small-time traders, right? The mom and pops, like the family, like the guy, has never been more long in the equity market ever. This is a new record, right? And it keeps going up, and we're now at like unheard of levels, meaning all the dumb money, right, is on one side of the boat, which is long equities, like can only go up. Stock markets only go. Everybody's positioned that way. Okay, not everybody. Everybody but the sharks are positioned that way, right? The sharks are the big institutions and hedge funds who have insider info, believe it or not, right? To some varying degrees. Everybody else, the dumb money, including me, small-time traders, are positioned, well, I'm not positioned, but everybody is positioned on one side of the boat, which is market's just going to go up. I don't like that. I really worry about those situations where the dumb money is all on one side of the boat, because when that happens, the moment it tilts the other way, guess what happens? And it's going to be a pretty big, because I told you the gamma's been cleared out with the clogging of the drain, right? So if there were to be it will be a straight up dump, right? Because there's no more of this gamma positions that are holding things together. So I don't like this at all. I don't like dumb money all on one side of the boat. Dumb money, time again, has been proven to be wrong and get screwed by the sharks. If you don't believe that, then you probably shouldn't be in equities doing trading. The other thing going on that, okay, this is a wild card. I may be right or may be wrong, but look, the Israel-Iran escalation path has been set. There's no turning back now. Israel is going to strike without a doubt. And Iran has said they will strike back. And what Iran has said in their strike back is that they are going to strike other Gulf oil-producing countries, Saudi Arabia, United Arab Emirates, and the list goes on. Qatar, their oil fields. And why would they do that? Because they would do that to basically kill the world's oil supply, which would be super, super problematic. And so what happened was the Gulf states actually came together with a statement, on October 3, and basically telling Iran they're going to be neutral, which means U.S. cannot launch any attacks from any of the air bases in any one of their sovereign lands, to try and placate Iran so that Iran doesn't blow up their oil fields, which it has done in the past. Like it blew up Saudi Arabia's oil fields in the past. Saudi Arabia couldn't do anything about it, right? So they're very worried that Iran's actually going to do this. And so they came out together and issued a statement saying, look, we're neutral, which is a kind of a way saying that they support Iran without really burning bridges with the US. And look, it's a real threat. Whether it happens or not, I don't know. I can't tell the future, but this is something I'm definitely watching carefully, because if it does happen, we're looking at about half of the world's oil supply taken off the table in an instant. And you know what that's going to do. That's going to do this. So last week, the price of oil, because of the conflict and Israel threatening to strike Iran's oil field, the oil shot up like vertical, right, the last few days. And that's not a good sign, right? Because if we look at what happened in the 70s, we had two major oil shocks. Now, the 70s had three major inflation spikes, right? And two of them were, the big two ones were induced by oil shocks, right? Because of OPEC basically controlling the supply. And we saw a 4x increase in oil in the first one, from 3 to 12, 400%. And then the second shock went from 13 to 39, right? 3.5-ish. So it went from 3 to 39, basically, right? 3 to 40 almost. That's over a 10x increase, or 1,000+% increase in the price of oil. Now, I'm not saying we're going to have 1,000% increase in the price of oil here, but this has happened in the past, right? And let me show you something that I'm carefully looking at. These three inflationary waves of the 70s, we are following this in today's world. So the blue and the red, right? We are tracking. So that first spike, we tracked it, right? We tracked it going into 2022. Then what happened since then? We continued, we peaked around the same area, right? And we started going down. This is when the Fed started raising interest rates, right? So we tracked this first one, and now we're tracking the second one, right? Track the first one, and now we're tracking the second, and it pivoted in a similar relative spot, right? And started going down after the Fed started raising interest rates. And this was back in so back in the beginning of 2023, we were like, wow, like, is this going to happen? And that's exactly what happened. Thanks to the Fed raising interest rates, we went all the way down. And so then the question now becomes, well, are we going to stop around here? And if we do stop, are we going to start going back up? And this is known as the Anthony Burns, where the Fed back in the 70s cut interest rates thinking that it had defeated inflation too quickly. And that caused the second spike along with the second oil shock. And so here we are. We somehow paused around here magically. You can't, if you think we're living in the simulation, this is it. We paused magically at around the same area, right? And with the last, and all of a sudden the Fed pivoted here and said, we're going to cut interest rates by 50 basis points, right around when Anthony Burns did it the last time, which caused this whole thing to skyrocket. And so the question now is, with the 50 basis point cut the Fed just did last month, are we going to follow it up here? We don't know. Nobody can tell the future, but we've been following this all this time. And then if you look at the conditions of what's going on in Iran with a potential oil shock happening, consistent with the oil shock that happened in the 70s that caused their spikes. I mean, you put these things together and you're wondering like, hey, there's actually a legit chance with the Fed cutting rates maybe a little too early, and with a jumbo rate cut when apparently everything's doing well, right? Employment great, stock market great, real estate great, GDP great. What's going on here? Now, in my earlier video, if I told you, like, I've been accumulating gold bullion in a vault here in Singapore for the past couple of years, and it has done nothing but go up, right? Now, my gold is a protection of my purchasing power. It is not an investment. It's not to make money, right? To make money, I do this stuff, right? I do this stuff to make money. And this is a much tinier percentage of my net worth I do this with, because I can afford to lose all this, and I'm okay, because that's not the bulk by any means of my stash. My stash is primarily gold, right? And it has just increased over time, right? And it's probably going to increase, like it's probably going to double since I've been accumulating. And I think a discount will open when there's a liquidation event and a liquidity crisis, and I'll probably add more when that happens, right? Because let me show you what happened to gold in the 70s. And the 70s is what we're looking at, right? Look at this, right? And this is from 1976 to 1980. So it's not even from 1970 to 1980, which I'll tell you in a bit. But from midpoint 70s, gold went from about 100 to 900 for a 900% increase. This is while this was going on, right? 80s. That was the peak of inflation, right? So during this is what happened. We're in the middle of this, I think. Now, if you actually extend this to from 1970, right, to 1980, where gold in 1970 was like 35 bucks, we're looking at a 2,500% move from 1970 to 1980 for gold, right? 2,500 from 1970 when this started. 2,500% move. Am I saying that we're going to have 2,500% move this time in gold? I don't know, right? Again, I can't tell the future. But so far we're tracking this behavior. So far we're tracking this behavior, right? Question is, will this happen? We've got a hot war in Iran and Israel threatening oil, could it happen? It's looking more and more likely, right? And so for those reasons, these are longer, term fundamentals that I'm talking about. Now, coupled with the price action, the technicals that I also talked about, I do think that it is coming, and it combines to form the FoFty preparation of an incoming recession and depression, and increasing chances of global world wars. And what are we going to do in order to prepare? And right, then the preparation is both from your money and your assets to protect that and to be able to make money on that, and also your internal mental fortitude to make the changes that need to be, because they're not easy to make, these changes, right? So you're going to have a reset in your mind to think in the proper way to make the difficult changes before it happens. Because if you start to make the change after it happens, after you get the shock, it's too late. It's too late. And so that's the whole point of FoFty, right? Is to give you both a map, a pathway, to show you what I'm doing. Look, I'm even showing you what money I'm putting in, right? And what's going on with it in terms of at least equities, right? And also the internal reset, which I'm writing a manuscript on how to reset ourselves mentally and spiritually, which once I'm done, I'll be sharing with people. So having said that, let's see what next week brings. I think it will bring in more volatility, which is why I left all of my positions and haven't touched it in over a week, and don't plan to touch it until next week, and we see what's going on. So until next week, peace.